Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, hey, look, I'm just trying to save you a little money. My job is not just to entertain, but to explain, teach, put in context. Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. Valuation matters. Sure, you can pay whatever you want for a stock. It's personal you. You don't have to tell anybody. But the price you pay does ultimately matter to your bank account, especially if you're one of the people who got in on the initial public offering of Figma, the digital design company, which priced its IPO at $33 today, then saw it open for trading at $85 and finished the day at $115 and change. Did you take some off? Did you ring the register? Or did you just let it ride? Somehow Figma captured the zeitgeist of the entire joint. No, of the entire market. Even as the averages got hit today, Dow sliding with 330 points, S&P declining 0.37%, NASDAQ edging 0.03%. And do you know why that happened? Was it the Fed? Was it the president? Was it earnings? No. It happened because of Figma. This market went down because of Figma. Why? Because valuation matters. What matters to this market is to be reasonable. And we weren't today. Today was dominated by euphoria. And guess what? Euphoria is bad for business. What should have been about? Well, how about Microsoft? How about Meta? Nope, they were overshadowed by the Figman Carnival. It was all anyone talked about down here. Call me old-fashioned. But I really wanted the market today to be defined by those earnings reports from two tech titans. I'm talking about Microsoft, briefly a $4 trillion company today before closing just below that level, and Meta at just under $2 trillion. I wanted these to be foundational. Which is the word that every CEO now uses about anything important, which I have no idea what it means, but it sure sounds great. I wanted it because they smashed estimates. I mean, they crushed them by billions of dollars. These were marvels. They did so because they spent fortunes on artificial intelligence, something which many thought to be foolhardy, but it turns out to be they didn't spend enough. Microsoft shocked people by obliterating the earnings estimates. Now it sells at roughly 35 times earnings. Meta, which blew the estimates away, Kingdom Come, sells for less than 29 times earnings. Given how spectacular these reports were, it was natural, totally natural for the stocks to go up. Microsoft gained nearly 4%, Meta jumping more than 11%. Lots of people today, I heard them, they were grousing that these stocks have become too big. Oh, that's not the problem. They were bemoaning that they're now bigger than some national economies. I say they're still too cheap, and most national economies are an inflation binging joke anyway. I'll take their balance sheets over any country in the whole world. We pay 35 times earnings for Microsoft, 29 times earnings for Meta, because we look at the benchmark, the valuation, the S&P 500, and the aggregate. That sells at 24 times earnings. Then we try to assess how much better Microsoft and Meta are than the average stock, and they are really better. You see, we have something. We got to pay something for them. We have to do it, right? We can't just say, oh, heck, I'm not going to buy those, or let's not value them. They're companies with stocks, and we have a tried and true way to value the one that I told you about, the one that involves their earnings and the price we pay. We use relationships to figure out what we should pay. Of course, those relationships can always lead us astray. S&P could quickly fall. Microsoft, Meta, maybe it's a spike. But the fact is their earnings were amazing, which is why their stocks were unstoppable today. Why am I going through this? First, it's because I'm truly astonished by the numbers these two companies put up. They belong in that Magnificent Seven. They're like Yul Brynner and Steve McQueen. But second, and far more palpable, we care about those valuations because even though Meta and Microsoft are two of the largest companies in the world, today's market was defined by the action in a smallish design software company that came public and immediately traded north of 60 times sales, not earnings. Sales! Earnings good, sales bad. Sales, $19.99. Earnings, 2025. Now, I'm not disparaging Figma here. This is not some profitless company. It makes money. It grows fast. Consistently performs. I like the product. Used by everybody. Used by me. Used by my family. Bargain. But there's a problem here. Problem with Figma stock. The price made no sense whatsoever. It's wildly inflated because it doesn't make that much money. In fact, it makes so little that I can't even use a price-to-earnings multiple. I use for Microsoft and Meta. Valuation is irrelevant when we talk about Figma. Irrelevant. How do we value it then? There's really only one way. You have to judge it on a price-to-sales basis. And what you look at on that basis, using a fully diluted valuation, is some at the go-out 67 times our rough sales. 67. And that assumes 40% growth. Meta sells at 10 times sales. Microsoft, 12 times sales. It just doesn't compute what happened here today. On a day when these two giant companies reported phenomenal numbers, with much more of their newfound growth coming from profitable artificial intelligence investments, we had no choice but to focus on Figma, because they couldn't get the darn thing open until 1:59 p.m. Figma's all that mattered. A deal priced at 33, opened at 85, and then went to absurd levels. The Figma deal mattered more than the two giants because it's the worst possible sign of froth. I hate it. They know nothing. You know what I want to do it? I want to call it Fig Newton's law. That's right. What goes up must come down, okay? And not tomorrow, maybe not Monday, but this is Fig Newton's law. You got me? It's just that this may mark a whole new phase of the bull market, the phase of ludicrous valuations, that the year of marvelous thinking will be gone. You have to hope that Figma's a one-and-done bout of enthusiasm. It just can't be the norm. Did you hear me? And as someone who brought a company public during the heyday of 1999, I know what I'm talking about. We don't want to go back to the bubble territory. What do we want to focus on? The hits and misses. Microsoft and Meta were terrific. For a while, they ignited everything data center, but as we waited for Figma to open, who saw their net worth catapulted to the skies, to the stratosphere? Everybody else lost money because the adults know that they have lost control of the narrative if there are more Figmas. And I don't want it to happen. I just don't want it to happen. The profit taking was tremendous as everybody watched the Figma carnival. Yeah, like Qualcomm, that was down like 8%. Geez, excuse me. Figma can kill the bull. And I don't want it killed. After the close, we drifted from lunacy back to reality. Amazon reported what I thought was a good quarter. Healthy top and bottom line beat. Don't talk with your mouth full, Jimmy. Much better than expected sales in every division, even if their web services margin was light. Oh, give me a break! Unfortunately, Amazon gave mixed guidance, but they always do that. That's what they do. It's my largest position in the Travel Trust. I'm not worried about it at all. I am worried about, what do you think? I'm worried about Figma's law! And Amazon stock got hit, but, please, it's getting crushed in after hours. It's just going to be another buy. Now, we also heard from Apple, whose sales and earnings came in substantially better, thanks to surprisingly strong iPhone sales. Even their Chinese business improved. People always want to write off Apple as a no-growth company, best days are behind them. But they just put up 10% revenue growth, a reminder that this remains one of the greatest companies on earth. You know what I say? Own it, don't trade it. At the end of the day, I hope we can go back to focusing on earnings rather than getting more IPOs like Figma. We got to put this genie back in a bottle. If this is merely a day where one day of higher valuations, I can handle it. But the genie will wreck us if it stays out. Maybe the best thing is to try to get at least one wish from the genie. Don't let the inmates take over the asylum. The bottom line, if we can stick to price to earnings multiples, not price to sales, that means the bull would still be intact, and we can live to make more money another day. Everyone acts like Microsoft and Meta have reached insane valuations that are way too high, but their stocks are priced very reasonably. If anything, they deserve to be a lot higher. If the Figmas of the world that have gone to crazy levels and are probably set to go higher still before they repeat the lesson, if they win, then let me just say we are all on borrowed time. Carl in Illinois. Carl.
Yeah, Jim. Hey, the stock I'm calling about seems to have no momentum, and I'd like to be around when it catches wind. I wanted to get your opinion on Wendy's.
Wendy's about to report, and it's not going to be pretty. They got steak problem. Meat. They got competition. They got so much wrong. The only thing they got right is that darn Baconator, because I know my wife eats them in her sleep. Let's go to Sharon in Maine. Sharon.
Hey, Jim. Just a club member here. Really happy with you. Thank you so much for all you do and the whole group.
You're kind. You're kind. Let's keep. And what we want to do, remember, we want to get the froth out of the building. That's what I'm trying to do. Bring the rats in and get the froth out. So how can I help you?
So Spotify, with the economy seems to be faltering. What do you think? Buy or a hold?
Sharon, I was so mystified by Spotify. That was a really not great number. I don't get it. I don't know what happened. I can't own the stock until I figure out what the heck happened. All right, look. If we're going to sink to the idea of price to sales, which is what moved on Figma, I got to tell you something. This is going to be this, and I don't want it to happen. Microsoft and Meta are priced reasonably. It's the Figmas that have gotten out of control. Hey, by the way, Look at Carvana. That was pretty good today, wasn't it? I mean, that's a high stock, but it's making a lot of money. And, you know, after the close, everyone's bemoaning Amazon. Oh, go ahead. After you order everything tonight on Amazon, you can bemoan it all you want. And you can do it through your Apple phone. Picture my wife. Okay, anyway, the Federal Housing Administration Finance Director, Bill Pulte, is accusing the credit score company FICO of being a monopoly. I'm going straight to the source at FICO to hear what they have to say. Gold's been glimmering lately. Investors missed the boat. I don't think so. American Eagle's still there to be had. I'm sorry, Nico Eagle. What I can tell you, this is what happens to me when the Figma Carnival should be over. Oh, and don't miss my exclusive with the gold company either. All right, what can I say? I'm going to put all these in my mouth. Yeah, you think I'm into fitness? I'm into fitness in my mouth.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.